Dean Michael, the Tax Doctor here, CEO and founder of Tax Help MD. Today I want to talk to you about the equation used to figure out which programs you qualify for, hardship programs offered by the IRS. And the equation used is to determine your NDI, or your net disposable income. In order to determine your net disposable income, the IRS takes your total household income and they subtract what they call absolute necessary living expenses. Now that's food, clothing, miscellaneous, housing, transportation, and medical. Anything else they don't care about. So they don't care if you have children in private schools, you're paying student loans, or you have old medical bills. None of that matters. All that matters is what you need to live, breathe, eat, and work. So for this calculation on the board, taxpayer has $3,500 in income. IRS uses a national standard for food, clothing, and miscellaneous. Now that's determined by which county you live in and how many people you have in the household. For this particular equation, it's just one person in the household, so you can subtract $585 for food, clothing, and miscellaneous without having to prove every cheeseburger you ate and every bar of soap that you used. Next that we need to take into consideration is your mortgage or your rent if you're not a homeowner. If it's mortgage, it's going to take into consideration taxes and insurance, of course. There's $1,500 in mortgage on this one. Next is your utilities, which is your electric, gas, water, cable, internet, phone. I'm not going to go through all the numbers because they're obviously illustrated here on the board. You have your car payment, the auto insurance for the car, fuel to get back and forth to work, medical insurance, co-pays, prescription, life insurance, whether it's whole life or term, and then of course court-ordered payments like child support, alimony, judgments, anything like that. For this particular case, he's got $300 in child support. For this taxpayer, after subtracting all of the absolute necessary living expenses, he has a net disposable income of $10. Now it doesn't matter if you owe $5,000, $10,000, $100,000. Doesn't matter. All you're going to end up paying is $10 a month, and you're going to pay that until the collection statute expires on your debt, otherwise known as a CSED, Collection Statute Expiration Date. The IRS has 10 years to collect their debt. It's from the date of your original assessment. So for example, if this particular taxpayer only had 5 years from which the IRS can collect, that would be another 60 months. 60 months times $10 would be $600. That would be all he would pay, then the debt would expire. So again, it's a lot better than probably some of the settlement programs out there where you may or may not get qualified. This is strictly based on math. So if we can prove on paper when we present your case that all you have left over is $10, $25, $35, whatever it is, that's the amount you're going to pay until the collection statute expires on your debt. So if you've been one of those taxpayers that's been approached by maybe some of the companies on TV that are promising to settle your pennies on the dollar, don't be fooled by it. Don't be fooled by the companies promising you the moon and you end up with a piece of cheese. If you want the truth about your situation, give me a call for a free consultation. We'll sit down, we'll do the math, we'll figure out exactly what you qualify for your specific situation. Again, my name's Dean Michael. I'm the Tax Doctor. You can call me at 888-632-4506. Let's figure out what's really available to you. I'll give you the truth. Thank you for listening.